In 2022, Russia lost access to roughly $300 billion of sovereign reserves held abroad. No vault was robbed. So what happens when countries stop trusting the dollar system? Somewhere in your phone, there is a banking app. Open it, and your savings are just there. Yours, obviously. Now imagine waking up tomorrow and the number is still on the screen, but frozen. Not because you did anything wrong, because your bank was ordered to block access and you got caught in a conflict between governments. Now scale it up. It is not your savings. It is your country's savings. Decades of exports, taxes, and national rainy day money parked inside financial institutions beyond its borders. That is the real lesson of 2022. The United States, Europe, and other partners immobilized roughly $300 billion of Russia's central bank assets held abroad. Russia still legally owned those assets, but it could not freely use them. Every central bank watched that happen. Gold buying was already rising. Then, central banks bought more than 1,000 tons a year from 2022 through 2024, followed by another 863 tons in 2025. So, here's the question this whole video hangs on. What actually happens if the dollar stops running the world? Not disappears, stops running it. That difference is everything. Let us start with where we actually are, because the numbers tell a cleaner story than the shouting does. Since the end of World War II, the United States dollar has been the world's default international money. When Malaysia sells palm oil abroad, the contract may be priced in dollars, even when no American company is involved. When a government or company borrows across borders, the debt is often written in dollars. When a central bank wants liquid assets, it can sell quickly in a crisis. American government bonds are a traditional answer. At the peak in 1999, about 71% of disclosed foreign exchange reserves were held in dollars. The latest official reserve data, for the first quarter of 2026, puts the share at 57.1%. That is a real decline, but notice what happened in the latest quarter. The dollar's share actually rose slightly, partly because exchange rates changed. So is the dollar collapsing? No. 57% is still overwhelming reserve dominance. The euro is near 20%, the Chinese renminbi is below 2%, and reserve share is only one scoreboard. The dollar was on one side of about 89% of all foreign exchange trades in 2025. It is also used for roughly half of international payments and a very large share of trade invoices and cross-border borrowing. That is not a dead currency. It is a currency with a smaller share of one market while remaining deeply wired into almost every market. But here's the thing about a dam. You do not judge it only by whether it is still standing. You also watch where the water is being redirected. Why does the dollar run so much of the world in the first place? The honest answer is a network effect, and the easiest way to feel it is your group chat. Why is your family on the same messaging app? Because everyone else is already there. The app does not have to be perfect. It just has to be where your parents, cousins, school friends, and colleagues already are. Moving means convincing everyone to move with you. The dollar works like that. Trade is invoiced in it. Debts are written in it. Banks hold it. Investors can buy and sell enormous amounts of dollar assets quickly. So people keep using dollars because everyone they need to deal with already uses dollars. That loop is genuinely powerful, and it is why predictions of an overnight dollar death have been wrong for decades. But a network like that runs on more than habit. It runs on useful infrastructure, deep markets, legal confidence, and trust. And that brings us to the part most coverage rushes through. A system called SWIFT carries secure payment instructions between financial institutions. Think of it as a standardized messaging network for banks. But SWIFT does not actually move the money, and Washington does not own one giant red button. The real leverage comes from several choke points working together. Banks need correspondent accounts. Dollar transactions often pass through institutions under United States jurisdiction. Securities may sit with custodians in the United States or allied countries. Governments can order regulated institutions to block access. There is no single off switch. But when those choke points close at the same time, it can feel exactly like one. To you, a dollar may look like a neutral note in your wallet. To a foreign government, dollar assets are also legal claims inside a network of banks, custodians, clearing systems, and governments. Ask yourself the obvious question. If you ran the central bank of a country that might one day face Western sanctions, what would you do? You probably would not dump every dollar tomorrow. That could damage your own currency, crash the value of assets you still hold, and leave you without enough liquid money for trade. You would hedge. Quietly, gradually, without announcing that you were heading for the exit. That is where gold enters the story. Gold held inside your own country has no foreign issuer. It is not somebody else's promise to pay. It cannot be created by another central bank, and it is harder for a foreign government to freeze remotely. That does not make gold magical. Its price moves. It pays no interest. It costs money to guard and transport. A gold bar is also awkward when you need to settle millions of ordinary transactions. So gold is not replacing the dollar as the world's everyday payment system. It is becoming a larger insurance layer underneath national reserves. The surveys say that concern out loud. In one 2026 survey of 76 central banks, 74% of respondents expected the dollar's global reserve share to be lower in 5 years. 89% expected total central bank gold holdings to rise over the next 12 months. A separate 2026 study of 54 central banks found that 61% believed United States debt levels were damaging the dollar's long-term position as a reserve asset. But this is where the story needs a correction. Sanctions are an incentive to diversify. They are not proof that the dollar's decline is suddenly accelerating. A recent analysis of global reserve data found a gradual long-term shift, but not a clear statistical acceleration after recent sanctions. In plain English, the leak is real. The claim that the dam is about to burst is not. So who wins and loses if the leak continues? Start with the United States. Dollar dominance gives Washington cheaper and more reliable access to global financing than it would otherwise have. It lets the country borrow mainly in its own currency. It also makes financial sanctions unusually powerful. Economists have called this an exorbitant privilege, and the phrase fits. It is like being the one person in town whose IOU notes are accepted almost everywhere. But the privilege is not a free money machine. If the dollar's role shrank gradually, the United States would not suddenly go bankrupt. The more plausible cost is at the margin. Slightly weaker demand for dollar assets, somewhat higher financing costs, and less ability to isolate another country through finance. Now China and other emerging powers, they want more room to trade and save without depending on systems they do not control. But the renminbi cannot simply take the dollar's chair. Why not? Because a reserve currency has to be easy to move, easy to sell, and backed by a huge supply of trusted assets. China still controls cross-border capital flows, and foreign institutions cannot move money in and out as freely as they can in major Western markets. Who parks a national emergency fund somewhere if the exit door may narrow during the emergency? So China's realistic path is not instant global replacement. It is more renminbi use in selected trade corridors, more bilateral settlement, more payment infrastructure outside the dollar network, and more gold as insurance. Europe and other American allies mostly want stability. They benefit from the existing system, but many reserve managers also want diversification, so that one political or financial shock does not hit everything at once. Now consider the loud version of this story. The dollar dies next year. A single BRICS currency appears overnight. America immediately gets hyperinflation. I would file most of that under entertainment. Reserve currencies usually lose ground over decades, not over a weekend, and there is no obvious successor waiting with the dollar's combination of open markets, enormous safe asset supply, legal infrastructure, and global usage. The British pound is a useful warning against instant collapse stories. Britain's economic and imperial dominance weakened long before sterling vanished from international use. Monetary habits can outlive the power that created them. But the doomers get one thing right. Diversification is real. It is measurable. It appears in reserve shares, new payment routes, and piles of physical gold. This is not the death of the dollar. It is the end of the idea that there can only be one serious route. So what happens next? The most likely path is a more fragmented, multipolar money world. The dollar remains the largest currency in reserves, trading, and finance, but its share keeps facing pressure at the edges. Gold grows as neutral insurance, not as money you use for every invoice. The renminbi expands in selected regional trade. The euro and smaller reserve currencies keep useful roles. More countries build local currency arrangements for particular partners and commodities. Picture an exaggerated example to make the mechanism obvious. Today, the global economy is like a city where almost every major road passes through one giant interchange. DeDollarization does not mean demolishing that interchange tomorrow. It means countries slowly build side roads. Most traffic still uses the main junction because it is faster and deeper, but if the junction is blocked, more drivers now have another route. That is the reversal. A less dollar-centered world may give some countries more geopolitical breathing room. It may also make global trade more complicated, not less. More currencies mean more exchange rate risk, more hedging, more payment systems, and more friction. Freedom from one choke point can create 10 smaller toll booths. The development to watch is not one dramatic headline about a new currency. Watch several indicators together. Does the dollar's reserve share keep falling after adjusting for exchange rates? Do major commodity exporters invoice a persistent and meaningful share outside dollars? Do non-dollar payment networks gain volume beyond politically friendly trade? And do investors still treat United States government bonds as the market they run toward during a crisis? My expectation is gradual erosion, not collapse. Sanctions, debt concerns, and geopolitical rivalry will keep pushing countries to build alternatives. The depth of dollar markets and the weakness of the alternatives will keep most of the old system in place. And my honest take, straight up, is that the United States can accelerate the change through its own choices, but it cannot be blamed for all of it. Countries diversify for many reasons: return, liquidity, exchange rates, trade relationships, domestic politics, and simple risk management all matter. Still, every broad asset freeze reminds reserve managers that political access is part of financial safety. Every freeze can win the day while spending a little of the decade. For more than 80 years, much of the world kept its savings and wrote its contracts in one country's money because that network was useful, liquid, and trusted. Now countries are not burning that network down. They are building exits. So where do you land? Is this a slow leak Washington can still contain, or is a multipolar money world already locked in? Drop your view in the comments. I do read them. And if this connected the dots for you, leave a like, send it to someone who still thinks DeDollarization means the dollar disappears, and subscribe for more. See you in the next one.